6.5 million job openings, where the expected number was 7.2 million.
We've talked a lot about truflation. It's everywhere, and it's making the news right now because it's showing inflation well below 1% on its way to zero.
In the year 2015, the average size of the home purchased in that year was 2,687 square feet, almost 2,700 square feet.
Today, the median price home is roughly $419,000, 76 ounces of gold. Episode 76 of the award-winning Market Moves with Mark and Jeff. Two uninteresting guys talking about interesting times. And Jeff, we've got a load of interesting topics to discuss today. Jobs report just printed a few minutes ago. Is inflation and jobs leading to some changes in interest rates? We have a new Fed chair in Kevin Warsh. What does that mean for the real estate market? We've got a couple of attempting disruptors in Opendoor and Homes.com, both making news one way or another. So excited to talk about that with you, along with home affordability. We are talking a lot about that here, and maybe providing some different perspectives on affordability and how we should be looking at it from a macro perspective.
All really interesting topics, Mark. Excited to jump in and dive into those. Kind of like the layout a little bit of just giving people a warning as to what topics we're going to be trying to tread water in in this episode this week. But our intro resonates with me that though you and I may not be interesting, there really are just fascinating things happening, and it's all we can do to even try to keep up with them. But fun to see and be diving into these topics for sure.
Yeah, I look forward to uninteresting times for sure. Some of the what makes all of this interesting is all of the uncertainty that we've spent a long time talking about. And it's difficult to do business in climates like this. And I think that some of the difficulty over the last 13 plus months are setting up a pretty fun runway. But boy, do we need to get there. You see some signs of us getting there, I think. So let's see where we're at. Look forward to chatting on this with you. And Jeff, we just an hour or two ago before we recorded here, of course, this will be days ago once our listeners start listening, but we had a jobs print today. And Jeff, before you tell us about the jobs print, just a reminder to the audience and to you and I that the Federal Reserve generally has a dual mandate, and it is to keep inflation tamed and down, roughly in the 2 to 3% range, but also to keep a healthy job market. And they do that largely with controlling interest rates, but also with I guess balance sheet investments one way or another, buying and selling mortgage-backed securities and the like. So with those two mandates, those are kind of what they're reading and seeing here. And so jobs in the job market is a really important one here, Jeff. What did we learn today?
Yeah, you bet. In fact, I'll share for those that are viewing a little bit of data, but then talk through it as well. And I mean, the punchline, Mark, is it's good news for us. We're still in this era of bad economic news is good news for interest rates and for anybody who's in a space that's dependent on interest rates, like real estate, generally. So what we had is a read or a printout that came with 6.5 million job openings, where the expected number was 7.2 million. And so, far fewer open jobs than were anticipated. And added to that was a revised downward number for November of an additional $200,000. Keep wanting to say dollars, 200,000 jobs that were reported to be there but weren't. I'm not exactly sure how you misread that necessarily on the revision, but not great that there are fewer jobs for people or that unemployment may be starting to tick up, but very helpful from those caring about lower interest rates, wanting the Fed to have the fodder to further cut their interest rate, because any concerns about employment stability is going to lead the Fed to err on the side of wanting to provide a more favorable lending environment.
Jeff, chart we didn't prepare for this is a manufacturing index. And you might have looked at it a little closer than I did in our show thread that we kind of communicate on each week. But I think my read on that was that January manufacturing numbers or indices were up. Like there's some excitement building in manufacturing. Is that how you read it?
Yes, it is. That manufacturers index, I think their midpoint is 50. And so anything north of 50 is positive sentiment. Anything less than 50 is negative sentiment. And I don't have it to share here, but it was a marked step up. It was interesting. I was listening to an article from the Wall Street Journal this morning talking about in 2025, manufacturing output in the US had actually continued to decline, which didn't surprise me because, of all of these deals that are being struck of bringing manufacturing, back onshore in the US, that hasn't happened like in 2025. Those deals have been negotiated. But, so this read of the manufacturer sentiment, I think was setting the stage of the expectations that in 2026 and beyond are going to, see that start to happen, even though it's not measurable yet.
Yeah, Jeff, and tariffs I think have a pretty big impact on 2025 as well. The supplies brought in for manufacturing to take place in the U.S. I think was really hampered by the deeply increased tariffs and the uncertainty that existed there. I've talked to a lot of friends of mine. I'm in Houston, so a lot of oil and gas services, and they're pipe manufacturing and all that sort of stuff. And so that they were short on supplies, and it was really hitting them. So that we have some optimism in manufacturing, which I think should translate to jobs up against UPS, laying off another 30,000, Amazon laying off another 16,000. I think we're starting to see a little bit of progress that might be measurable in AI efficiencies added in the workplace. That at least the first thought is, before I add somebody else, can I get this functionality or task completed with some sort of agentic solution? I'm sure the answer is no most of the time, but I think the question's being asked some 80+% of the time. And so we have less jobs open, less people looking to hire. And that is surely going to speak of a more troubled job market in the next several months.
Yeah, you bet. There's questions around, is artificial intelligence taking jobs or not? I don't know that it is at a meaningful level, but I do think you're starting to expect better productivity out of the current workforce that you have. So where I might look to hire to expand, that may not become necessary. Now, in a manufacturing world, I don't think we've got robotic solutions to the point where it's taking all the manufacturing jobs today. In more knowledge work and kind of task-oriented assignments that involve digital work on computers, I think you are starting to see some expectations of, hey, maybe we can get more done with the current workforce than what we've had. You referenced Amazon, and I've seen some stuff where some of these tech companies had really kind of ramped up through the COVID era, and now they're trying to kind of right size or get let go of either redundant spaces or jobs to try to maximize efficiencies. But I think are seeing some gains in what they can get from the current workforce without having to bring on new jobs.
Jeff, the Fed has a dual mandate. Make sure that the job market is healthy. This would indicate that the job market is unhealthy in a surprising fashion. Mandate 2 is to make sure that inflation is tamed, bringing us to the trueflation analysis. And we've talked about this. If anybody is following news like Jeff and I do, you may not. And I'm kind of hoping you outsource that, time suck to Jeff and I here, and we summarize that. Maybe that's the most useful thesis of the show, Jeff, is to condense the week's happenings into less than an hour. But we've talked a lot about trueflation. It's everywhere, and it's making the news right now because it's showing inflation well below 1% on its way to zero. And so we've seen this for 3 or 4 weeks now, way out in front of. It's more real time than what the United States data puts out. And I've been asking myself the question, okay, well, can we trust this trueflation data? I think they monitor something like 1,000 different products, kind of real time, to develop their index. Well, I think this is from a Bloomberg terminal here, but this is showing in white the trueflation inflation rates and comparing it up against the US data feeds. And boy, it's correlated, Jeff. And I think this tells me that we can at least directionally support. I don't know if it's going to be at the 0.86 that 0.86% inflation reading that it is, but it's certainly, I think I can confidently say that it's below 2% right now, which was what the Fed said they needed to get it under.
Well, and the thing that really stands out to me, Mark, and for anybody viewing this, it's helpful to visualize, but I'll describe it as best I can. This trueflation data has really been, kind of ahead of the curve. Like you said, I think it's more real time than what the CPI and the PCE data show. But this chart confirms that it's directionally accurate. And so, to your point, if we're well under 1%, and trending down maybe to 0% inflation, I would expect that in the upcoming reads of CPI and PCE, we will continue to follow that trend. And all of this just really sets the stage, I think, for the Fed to become more aggressive in interest rate cuts, because inflation's not a concern, unemployment is a concern. Their dual mandate is both pointing in the right direction, where, in the last year or two, Jerome Powell had continued saying, we kind of got things going the wrong direction. Employment's pretty strong, but we're worried about where it could go. Inflation isn't tamed in the sense of being at this 2% target that we have. So we're not sure what to do. We're going to just wait and see, has been a lot of the outlook from the Fed. This data, I think, is finally saying that, there may be bigger cracks in the job market than were anticipated previously, and inflation seems to be going where it should. I hope that trend continues. If it does, I think it could set up for a much more favorable lending rate environment this year than what others have predicted, which might make me lose our prediction bet that we made earlier this month. But I would welcome a loss on that if it's on the downside of interest rate numbers.
As bombastic and loudmouth as Bessent, Lutnick, and Trump are, I do think things are setting up to, and I don't even think they needed to set up in fully the way they are here for large interest rate reductions, but they are setting up, and that gives me a lot more confidence that we're going to see it. I think it's giving support to the argument that too late Powell is too late yet again, and way too late with interest rate reductions and looking at inflation as it was, or interest rate rises and inflation, being transitory. That was the joke before we started this podcast, back in the COVID days. So I think we've got a lot of reason to make moves here. So we'll see where we get. Now, if we jump to the next graph, it's not all dropping, Jeff. And I'll also say that a reminder to the listeners that inflation going to 0.8% is only saying that prices are increasing less. It isn't doing anything about the enormous increases in price that we've seen over the last 3 years to homes, to products, to all of that. It's just coming back down to earth, or not getting worse. And, so we're still here left to deal with increased prices on everything. And I'm not sure that toothpaste is being put back in the bottle.
I think that's the thing that's easy to misconstrue, Mark. And it's just a good point. I think worth emphasizing that pricing still going up. If it's going up 1%, it's still going to be more expensive, today than it was last year. Now, if it goes to 0 and beyond and starts to actually correct, I think that's where people start to feel, actual price, relief across the board. And of course, these things are measured in a basket. Not every single item is always more expensive. Eggs have come down in cost, for example, but that doesn't mean on average what I'm spending at the grocery store has. So I think that's worth emphasizing.
Yeah. Well, in the effort of balance here, and we certainly can't and shouldn't rely on trueflation data alone. Certainly the Fed is not going to be doing that one way or another. And so we have the Adobe Digital Product or Digital Price Index, and this is measuring things sold online. And this is showing a pretty steep increase. And I guess, Jeff, you had made the point about Black Friday in November. This is showing an increase in digital pricing. I think we just should balance that. And I only want to show it because of that. It seems like it's quite a bit higher here in January. And I think it's something to monitor, because this isn't all, straight downhill.
Yeah, I think it's a good point. Worth noting, the January 26th number is 4%, increase, where it's been as low as maybe negative 4% in November. It's kind of an interesting trend that November dips every single year. I'm assuming that's all of the Black Friday promotional stuff that happens during that month, where there are like notable steep discounts on pricing. But when you look on average, it's up and down, above and below the 0%, mark on average. But we're starting this year higher than at any other point in the last 10 years that are measured on this chart. So I think good to have the balance and the perspective that what you're spending online has gone up, and some of that might be tariff related. I would guess that online purchases might be impacted more by tariffs than some of the stuff I'm buying at a grocery store or other, like domestically sourced, products and that sort of thing. But I think a good point, Mark.
Well, Jeff, congratulations are in order for your correct Federal Reserve Chairman pick. I mean, this is pretty good stuff. This is hard to do, and it looked like both of us were going to be real losers here just a day or two after we recorded. But you were right on Warsh. Nice job.
I wish I could tell you I was real bright in making that. I was just playing the odds on Polymarket, to be honest with you. But I just because I got this right, I don't think means I'm not still a loser, Mark. But I got something right, so I take any win I can get, even if it's just betting with the crowd on a prediction market. But I'm glad to at least know who the next Fed chairman is going to be, and I think it gives at least some level of certainty and expectation. I did manage to win the bet that Jerome Powell was going to make it through the end of the year in that seat, and I'm not hearing any talk of removing him, before the term expires at this point. And I think everybody can expect, at least, what will happen with Warsh in there. A lot of the perspective has been historically, he's been a little bit more kind of traditional, like Fed outlook and perspective than he has the last couple of years. He's been the lone voter, or one of the few voters, for interest rate cuts, kind of against the grain with the others. I think that you're setting up to notch a win in our predictions as well, Mark. I would expect that unless Jerome Powell steals his thunder and cuts rates on his way out the door in a meaningful way, that Warsh will probably come in, make a big cut, and then let things ride for a while, which, as we've talked so much about, would just lend to greater stability in expectations in the market, which always leads to a more favorable investment environment, hiring environment, and it's just easier to make business decisions when you have pretty good confidence in what's going to happen in the future, as opposed to just constantly being unsure as to what tomorrow's going to bring.
Jeff, I think so. If you go back to our predictions recording, what I said was that Kevin Hassett, I think it is, was going to get it, but that I really wanted Warsh to get it. And so I am really happy with that. And all of the negativity that I have seen, and this is my honest read on it, is people that don't like Warsh think it's because he has this view of the Fed that we should not be hanging on the Fed chairman's every sentence or every word once a month, and that the market should not be holding to see what he does or what the Fed is going to do with the velocity of money and quantitative easing or tightening and interest rate drops. That the Fed should be a fairly constant existence that provides certainty for the marketplace. And so people look at this and say, whoa, the Fed over the last 2.5 decades or whatever it is have been wholly string pulling to the US economy one way or another. And I think that has been a total mess in the exact opposite of what I think the Federal Reserve should be doing for the most part. I mean, did they need to lower interest rates? Yeah, they probably did during COVID on some level. We probably also didn't need to shut down the government the way that we did. You could see kind of what was coming. But, and so they're saying Hassett was a guy that was going to come in and like kind of continue on this Jerome Powell, hang on every word, let's tweak something here, tweak there, see what happens. And that's not what I want at all. And I don't think that's what's healthy for the market. Drop mortgage rates. They don't affect mortgage rates, of course. They affect the federal funds rate, indirectly affects mortgage. But let's get mortgage rates to 5%, and let's just not move them. For the most part. I mean, only in enormous emergencies, one way or another. This is where I think we ought to be heading to, one way or another. And I think Warsh desires to get us close to that. And I think it looks like he believes. I don't think anybody would have gotten the job in the interview process if they didn't believe or want to implement rates should be 100 basis points lower than they are. Let's do that, and let's get out of the way.
Absolutely. I do note that you're positioning this of I lost the prediction, but I still got what I wanted, so I didn't totally lose here. I can't disagree though with the logic at all. I think the stability, I think the expectation as to where we're going to go, and then hopefully just hold for a time and allow the market to adjust and adapt, as opposed to are we going to cut them this meeting or not? They meet, I think it's 10 times throughout the year. It's just this constant drama that plays out, which I guess gives us something to analyze and talk about. But I'd be happy talking about other things, going on in the real estate space. But because interest rates are such a critical component in real estate, you can't help but just focus on what they're doing and where they're going, because it translates into people pulling the trigger and transacting or not. And we've just seen data point after data point of historically low number of transactions, of number of I think it was like 9.5% of canceled contracts on pending homes, or pending home sales down 9.5% month over month. Just all of these things that are kind of a byproduct of, well, maybe they're going to cut the rates next time they meet, so maybe I should just wait, and I don't want to move forward or whatever. And it leads to a healthier environment, I think, across the board for everybody, when you have a better idea of what to expect on more than just a 1 month or 6 week time period at a time.
As unaffordable as things are, Jeff, if they just came out today and said that we will not move interest rates for 18 months, it would create an enormous amount of volume. People would just stop waiting, because they're waiting for the next thing. And so let's get there. I am excited for the change. We need it. On some level, I've heard, I think Howard Lutnick talk about this, and maybe Trump too, but I don't even know how to reconcile it, but I guess on some level it resonates with me that we're the strongest economy in the world, yet we have some of the highest interest rates that are out there. It doesn't make a whole lot of sense. I don't know. Somehow that resonates to some degree, but neither here nor there. All right, so disruptors, Jeff. We've got Opendoor and Homes.com, both making news. We'll start with Opendoor. I don't know if they're necessarily making news, but I guess I'm on alert with them right now. I think you may be as well. They got a new CEO back in September. He is first name Kaz Nettajon or something like that. Don't know how to pronounce his last name yet, but he is kind of a tech all-star from Shopify and a few other places. And he's kind of, him and Keith Raboy and the venture capitalists and a few other folks have really injected some enthusiasm into the company with a way forward. They are now executing on that way forward, and I've been watching it pretty closely, Jeff. And the iBuying business has been a real loser. Zillow completely got out, Redfin got out, and there are more. I don't remember them now. I think that the folks that were deep into it that shut their doors. It's not been done well, and I think it's sort of been done from a tech perspective that was pretty loose in a lot of ways that I didn't love. But when this new energy was injected into the company and in a new visionary CEO, stock went from like 50 cents up to $10 or $11, Jeff. And that's when we began talking about it. It caught our eyes. And, my thought at the time was that I think this could be an interesting investment opportunity, but not at this price. And I would suspect, because the business model is still broken, it won't stay in the range that it was in that $10, $11. And so here we are sitting. I think it's just dropped into the high fours now. And I'm becoming kind of interested in this, Jeff. Not financial advice. What on earth does Mark know? He's a cartoon on a podcast, but I am interested in the business model and would love to chat a little bit about you with it.
Yeah, it's so interesting, and we've touched a little bit on this in the past, but you have early disruptors that can fall by the wayside. Like you look at a lot of the early internet companies and .com companies. Many of those did not succeed for various reasons, but some emerged drastic winners, and it really evolved how e-commerce, how we live our lives really today. And will this iBuying concept do the same thing in real estate? I don't know, but I kind of think that as much friction as there is in selling a home, that there is opportunity for that to change it. And will Redfin be the one that does it? I'm sorry, probably not Redfin, but will Opendoor be the one that does it? I don't know, maybe. It's fun to track and watch. Are we watching Google in early days, in their early days when there's a lot of competition and it seems really hard to to like disrupt or provide the pathway forward in this new, world that we're going to be living in? Or will Opendoor, struggle? It's been interesting to see them make the transition, Mark, and you've, commented to me about this early on. Their approach was buy price homes at like the biggest discount, the lowest price they could get, which ultimately led to, kind of an inventory of kind of poor quality homes or like least desirable homes in markets because that's what they could get the biggest discounts on. Well, those aren't easy to turn around and sell, necessarily. And so they have made a change to their approach. There was a term for, like buying the low end crappy stuff. What was that?
Yeah, it's adverse selection, Jeff.
There you go.
I this really resonated with me. I mean, what I have known iBuyers, we've got appraisers that have come from there to work with us, and so we've seen it kind of up close. And it just hyper aggressive acquisition strategies, either hyper aggressive on the discount to get, or hyper aggressive to meet a quota for number of properties brought in one way or another. But I don't think about this a whole lot, but when I drive by an Orchard for sale sign, I mean, their brand kind of is inventory that is not the most desirable. Not that it's bad. It's just, maybe the seller was struggling or just didn't care about maximizing dollars or something like that, Jeff. Those are the kind of images that naturally come to my mind. And what if it was top quality product? And so the one of the big adjustments, there's a lot, but one of the big adjustments is that they are going to try and go through much more homes at lower margins and buy good properties. And some of the outlining is, look, if we provide a lowball offer to someone, the only people that are going to accept it are the sellers that know there's something wrong with the house or some difficulty in selling, and I don't want to deal with it, and they're not very optimistic. And so that's the stuff that Opendoor and Redfin and Zillow would end up with. And that's not where you want to be. And instead, what they want to do is increase the churn. They want to be in the middle of a lot of these transactions as frequently as they can be. They don't want to hold on to them long. So they want to get in, make a small margin, offer a whole bunch of ancillary products and move on, and maybe hold on to services within that property once it's kind of entered into the ecosystem. So I don't know. A lot of that makes sense to me, Jeff. And one of their core principles is that AI can value the property better than a human can. I don't love that. And maybe it wasn't value. I think it was probably price, and that's a different story, Jeff. And their job is the job of the relocation appraiser, right? It is to estimate as best they can what they can sell the product for in a determined exposure time, days on market kind of thing. And I don't know, can a system get pretty good at that? I tend to think it might.
Yeah, there are a lot of reasons this is interesting, and that's certainly one that's foremost is how good can their pricing mechanism, strategy, and structure really become, because that's what what really did in, I think, the Zillow iBuying opportunity was that they got the pricing wrong, and a lot of appraisers, probably rightfully so, kind of danced on that grave of them going down, which I understand at some level. I think, at our core, we're all worried about, is AI going to replace or take our jobs, or some alternative like valuation approach or something. So it's really interesting just to observe, what are they doing now? Could they find themselves in trying to get a lot of inventory, end up overpaying, and then damage their profitability, even their viability, by getting the price wrong on the upside, by overcorrecting from only trying to get the very lowest priced properties? All interesting things to watch. One of the things that you pointed out too, though, Mark, that's interesting and does make sense to me from a business perspective of, if they're trying to get a lower margin in the purchase and sale of the home, but inject themselves in the services, that the home purchase can actually just be like the lead generation or the cost of customer acquisition, to be able to provide these other services and facilitate a lot more volume going through if they're not trying to just hold out for only the best deals. I've seen, maybe isolated incidents of this concept of, I'll provide a service for you at a like lower rate than I might otherwise, or take a lower margin on this buy and sell of the home. in order to offer other services as a way to get a foot in the door and provide kind of either a full stack or at least a number of additional services in addition to the main thing. And so I can see that being the pivot that they're making that could, really make sense. If I decided today I needed to sell my home because I'm relocating, because I've got something going on in my life, an option to sell it or to net as much selling it to Opendoor in 2 days, as opposed to having strangers come walk through it and go through the worry about, getting the proof for financing and the deal falling out of transaction or out of contract in 30 days and have to find a new buyer. Like, there are a lot of reasons that it would be really nice to sell my home in a matter of days as opposed to weeks or months in the current environment. So there's room to disrupt the way that this is done. It's really fun to watch. And are these guys early on going to solve the problem, and we're early tracking it or not? Time will tell, but it's really worth tracking and paying attention to, I think.
Jeff, in the old Bezos quote of "your margin is my opportunity," you got 6% agent commissions that are gigantic, and this money is changing hands on moving properties, and that is where the spread could be for someone like the iBuyer. I think that's generally the principle there. So there's just room if you could do it right. It has not been done right. In fact, it's been done far from right, like about as wrong and about as wasteful as it could be done by all the players that have been in the iBuying space, as best I can tell. But it still doesn't mean that the opportunity is gone. And so, for me, if this is useful to all, I mean, they've got like a $5 billion market cap, which is enormous for a failing iBuyer, which they have been. I think they are trying to get rid of the 65% of their inventory that they held pre-new strategy, but they're increasing their acquisitions, and those things are turning around pretty quick. So like the strategy seems to be working on some level. So I'm watching that really closely. They have, when I'm looking at an investment, I look at the CEO. I like the rock star type, Elon type that's out there. And I like what this guy is doing on a number of fronts. And it's just kind of listening to what he's saying, and how he's describing what he's doing. Is he doing what he's saying? Those sorts of things. And, in that same vein, I think that the CEO of CoStar, Andy Florence, I think that's his name, has been a real rock star. What a dynamo CoStar has been. Very difficult to be a customer of theirs. They're tough to deal with, but they have created an enormous amount of value. And they jumped into Homes.com to the tune of a $5 billion investment. We've all seen the guy from Schitt's Creek and Super Bowl ads, and they've dumped a ton of money into Homes.com. But they're getting a lot of scrutiny because they aren't making money yet. And I think investors are asking, how long is this thing going to take to actually be profitable, or will it ever be? You got any thoughts on that business?
Yeah, well, it's interesting to watch. And yes, I mean, they've definitely made a kind of a splashy entrance, into the space. And I think that's why there's just this risk of any particular player not being successful. Is at some level you have investors, you've got stakeholders that say, hey, we don't want to keep taking losses on this. And so the challenge for the viability can maybe be not that the opportunity doesn't exist in the market, but that their specific makeup and kind of, investor demands may not allow for them to have the runway that they need to be successful there. So it's interesting to watch, Mark. I really do think that we will see some winners emerge in this space. And I don't know that it's going to become it's going to take the place of 50 or 70 or 80% of total transactions that happen in the market anytime soon. But you've got people that see some real opportunity that want, I think, to be involved in as many of those transactions as possible and are continuing to pursue it. So it'll be interesting to watch. I've definitely seen some of the challenges of being a customer of CoStar. A lot of appraisers, I think, can relate to that. Whether this pivot and alternative strategy that they're pursuing plays out or not, I'll continue to watch with interest, just like with Opendoor.
Yeah, their business model is a little different than like what Zillow's was, but it is, it's kind of creating this, where you go to transact, or if you're thinking about transacting in the home space. And they're free to homeowners, selling subscriptions to agents, with boosted placements and that kind of thing, where where Zillow has been kind of traditionally a lead gen sort of thing. So just a different business model. The subscription model, as you and I know well, is something CoStar seems to like. So I don't know. I'm not exactly sure, but it's not working despite $5 billion invested so far. So I'm interested to see where that goes. Is that something they divest from at some point? Could the CEO lose his job over it? I don't know. He's done such a great job in the core business, but it's always difficult to venture into something new.
You bet. Well, that's why it's so fascinating to see Elon do what he does in so many different spaces, because you see like the challenge in this very specific case of the challenge even in the same genre of real estate. I mean, you're not building cars and rockets and batteries and tunnels and on and on, right? Artificial intelligence, et cetera, like that Elon's doing. So to your point, I mean, it's very, very difficult to make a significant pivot and have it be as equally successful as the first venture. Not that it can't be done, but yeah, certainly not an easy thing to do.
Well, Jeff, it wouldn't be a Market Moves podcast if we didn't comment on housing affordability and have a few charts and discussions here as our last topic for the day. You want to walk us through what we have on the screen?
Yeah, you bet. So this was a really interesting find, I think, that you had, Mark, and we see a number of different data points, over time. This was really interesting to look back on. And so the chart that we have up, I'll just describe briefly, and then we can discuss a little bit about it. But it is basically showing that in the year 2015, the average size of the home purchased in that year was 2,687 square feet, almost 2,700 square feet, at an average price of $353,000. Because also wouldn't be a Market Moves podcast if we weren't doing some sort of nerdy appraiser math, because we're interested in it. This was pretty simple, but so that equates to in 2015 an average price per square foot of $131. You fast forward to the end of 2024, and the average size of the home has gone down. The average price of the home has gone up dramatically, which doesn't surprise anybody. And we land at an average price per square foot of $217 a square foot, up from $131 a square foot. Just for those that aren't seeing the chart, the average size of the home went down from almost 2,700 square feet to about 2,364 square feet. The price went up from $350,000 to $514,000. So, homes have gotten smaller and way more expensive, in this 9 or 10 year period of time, which I remember home prices, being in the low to mid $100 square foot range. And, we're now well over $200 a square foot in many markets for many homes. And, some markets on the coast have been well north of that for a long time. But it's just interesting to see that the sizes have come down a little bit. And I think this is speaking to the affordability challenges of, people maybe resetting expectations on how big of a home they need based on the cost of it. But it's just crazy to see how much the prices have changed over time, with the incremental changes in the average size in that same period.
Yeah, prices have gone up. Materials have gone up. The cost to build has definitely gone up, and got so much more money supply out there because of the federal monetary policies. And the only way to meet a potential borrower where they're at in a way that the existing market can't is through building smaller homes, in low quality. We've talked a lot about these builders would much rather buy points down than put in upgraded flooring, cabinetry, or windows, or whatever it is. And so we've been seeing this trend. This was not the trend pre-high interest rate cycle, but now, we won't talk a lot today about the Trump homes policy that's being passed around news headlines and in interviews. Which we'll get to as soon as we have a little more concrete information. But I mean, it's 1 million homes, new construction homes. It's Lennar, it's Taylor Morrison, and the like. And they're going to keep doing what they've been doing, I think, which is kind of building as affordable a home as possible and flooding the U.S. with that type of stuff. Good or bad? I don't. Probably good at the end of the day. But I think that's what's coming. More of what we've been seeing.
I think that's right. I'd be curious to see if you're seeing this, Mark, but for the first time in a long time, I'm starting to see some of these homes that don't have the upgraded, granite or quartz countertops. I mean, I don't even know the last time I saw like new laminate type of counters, is just as a very single and specific example. But where I'm starting to see a little more of that in these entry level, trying to target the most affordable home prices possible for people. I saw one that was like 1,000 or 1,100 square foot, 3-bedroom, 2-bath home with very basic finishes, which just had not been built for a decade. It was all 1,500 square feet or more for a 3-bedroom home, and all granite counters and upgraded flooring and the stuff that you just listed. And I mean, this trend has really come back, and I think it's all in this effort to try to address the affordability that is clearly, not sustainable in the long run.
Yeah, Jeff. So to provide an interesting perspective on the subject of affordability, it's something that I've been thinking about since we started this podcast, 76 episodes ago. I remember us showing the median price of homes in places like Canada and Germany, Europe and Asia and San Francisco, New York. But as prices have gone up significantly, we certainly have an affordability issue, right? People aren't making enough in their monthly budget to be covering the cost to own a home or to get into a mortgage on a home. So that exists, and that is a problem unto itself. But this next chart is driving home a point. I don't even really know what to fully do with it, Jeff, but looking at the price of a median home in the United States and how many ounces of gold it takes to buy that medium priced home. In 2002, it took 500 ounces of gold to buy the $167,000 median price home. Today, the median price home is roughly $419,000, 76 ounces of gold. So in USD, United States dollar denomination, homes are way pricier, obviously, right? But in gold terms, you need far fewer ounces of gold to buy the real estate. And I wonder, in fact, this is certainly a statement about commodity prices going up, and whatever gold is doing right now with all this uncertainty that we keep talking about. But even if this was half different, it would still be more than half or less than half of gold required in 2022 to buy a house today. And so I think this speaks to not what it takes a homeowner to be able to pay for a mortgage today, which is just out of reach, right? Clearly out of reach. But the value of an actual home to asset prices generally on a historical perspective is just not that much. And tells me on some level that the pricing of homes could be supported, and we might not need to see some big drop in value. So there you have it, Jeff. I don't know fully what to do with it, but I think it's a really interesting perspective.
Yeah, it really was, Mark. And for anybody who's not able to see this, I'd encourage you to check it out as you're able. It's interesting because we've talked about inflation. I just spent some time talking about that. And I think that's one of the things that this highlights is that the value of the US dollar over time has changed dramatically, and more so than the value of gold or like other commodities or assets over time. And so this is not a way I have historically thought about home pricing, relative to other things or other assets out there in the market. But if I were sitting on a whole bunch of ounces of gold, home pricing today would be far more affordable than it was 20 years ago or thereabouts in the early 2000s. And like you said, I mean, of course, that's a function of what gold pricing has done over time relative to home pricing. But that relationship, and nobody's buying homes with gold. I mean, that would be kind of fun to go to the closing table and will in your today 76 ounces of gold. 20 years ago, your 500 ounces of gold. Kind of a funny or a fun image to think about, but it does speak to, I think, the reality of what inflation does to the value of dollars over time, and so that was one interesting aspect that stood out to me on this, Mark, that I just hadn't really considered before, but I think both can be true, that in terms of buying a home based on the monthly mortgage amount, that is problematic for most people on average, which is why we've seen so few transactions, in the last few years. I think that will have to naturally be addressed. But it has been the reality for a long time that people consider homes and housing affordability. You buy it based on the monthly mortgage amount, not necessarily on the overall price. We saw that in COVID. When home pricing was spiking dramatically, people weren't price sensitive to, I'm paying 5% more for this house today than what the one down the street sold for a few months ago. It was, well, I can get a 3% interest rate. I can afford that monthly mortgage payment almost regardless of how much more I'm paying today than the other one sold for recently. So it's residential housing is really priced in monthly mortgage payment as much as it is in overall like top line, asset sell price or something. And this really shed some light, I think, on how these asset prices have compared, over the last 2 decades.
Jeff, I don't think it's in anyone's near future to wheelbarrow 500 or 76 ounces of gold to a title company for closing. But, I think there are moments where we're not far away from doing that with Bitcoin or something like that, right? Which is a disconnected denomination from the dollar on some level. So, I don't know. I think it's just good to, the only direction, there isn't only one direction for home values to go being down. That isn't the only way. There's a lot of different ways to look at this, and you don't have to look very far to find logical explanations of support for home prices today as they sit.
I think that's right. And we've seen some, indications of like average wages, coming up a little bit. It's probably going to be a combination of things that helps address the affordability issue in the long run. You could see modest softening in home prices, in interest rates, and increases in in incomes to really make a difference. And the government is focused on trying to address other things, whether it's borrowing from or against IRA, retirement accounts, and other things like that. Like I think there's definitely a focus on attacking it not just from the traditional perspectives, but maybe from some novel or at least interesting and creative approaches as well. And I think it sets the stage for more transactions taking place in the coming years than what we've seen in the last few.
That's right, Jeff. Well, interesting times is the theme these days, and we are living it. I imagine the next 7 days are going to present a lot. We do have a really exciting guest coming on the show in Lawrence Yoon from the National Association of Realtors. Looking forward to talking housing for 2026 here and getting somebody that really knows, not just the armchair here, what's going to happen.
Yeah, I'm excited to have a conversation with him. Definitely an example of market moves punching above our weight in quality of guests, coming on. But for anybody who hasn't checked out the National Association of Realtors website, there's so much compelling information. We won't take time to review a lot of that today here, but in coming episodes we will, of course, with their chief economist. But there's just a lot of really good insight into what's happening in the housing market that they research and publish and make available to the general public. So a treasure trove of information with those guys for sure.
Well, I look forward to it, Jeff. We'll talk soon.
Till next time. Thanks, Mark.